Continuation patterns offer a visual and psychological anchor that confirms the trend is still healthy. This ability to hold and maximize winners, especially during strong momentum phases, is what separates average traders from consistently profitable ones. Mastering these patterns doesn't just improve your entries, it transforms your patience, discipline, and profitability over time. In this video, we'll explore everything you need to know about trend continuation patterns. We'll walk through the most common types, including flags, pennants, rectangles, and then break down how to trade them effectively using precise entry and exit rules. You'll also see real chart examples to bring these patterns to life, and finally, we'll cover the common mistakes to avoid, so you can trade with confidence and clarity. If that's something you're interested in, make sure to hit the like button to show your support, and subscribe to the channel if you're new here. Trend continuation patterns are price structures that indicate the current market trend is likely to resume after a brief period of consolidation or pause. These patterns reflect moments when traders temporarily take profits or when the market takes a breather, but without enough strength to reverse the existing trend. Continuation patterns suggest that the market is simply gathering momentum for the next move in the same direction. They usually form in the middle of a strong trend, whether it's bullish or bearish, and act as a setup zone for traders to enter in line with the prevailing direction. These patterns come in various forms such as flags, pennants, and triangles, each with its own structure and behavior, but all serving the same purpose: to provide a high-probability opportunity to join the trend with better timing and risk control. Now that we understand what trend continuation patterns are and why they matter, let's explore them one by one, starting with one of the most reliable: the bullish flag pattern. The bullish flag is a trend continuation pattern that forms when the price makes a strong upward move, known as the flagpole, driven by aggressive buying. After this surge, the market enters a brief phase of consolidation where price moves slightly downward or sideways within a tight, parallel channel. This is the flag. A valid bullish flag pattern is confirmed when price breaks above the upper boundary of the flag with renewed momentum. This breakout signals that the trend is likely resuming, offering traders a high-probability continuation entry. Conversely, the bearish flag is a trend continuation pattern that forms when the price makes a strong downward move, known as the flagpole, followed by a period of slight upward or sideways consolidation, forming an upward-sloping channel referred to as the flag. The key confirmation comes when price breaks below the lower boundary of the flag, signaling renewed selling interest and a likely continuation of the downtrend. While flag patterns are defined by their parallel structure, another continuation pattern with a slightly different formation is the bullish pennant, a pattern that often appears in fast, high-volume markets. This pattern forms after a strong upward price movement, known as the flagpole, followed by a brief period of consolidation within converging trend lines, creating a small symmetrical triangle called the pennant. The pattern is confirmed when the price breaks above the upper trend line, indicating the potential resumption of the upward trend. Conversely, the bearish pennant is a trend continuation pattern that begins with a sharp and aggressive downward move, known as the flagpole, which reflects strong selling pressure in the market. Following the flagpole, the price enters a brief consolidation phase, forming a small symmetrical triangle, known as the pennant, where price action compresses between converging trend lines. This phase indicates temporary indecision or a pause, as the market consolidates before potentially continuing lower. The pattern is confirmed when the price breaks below the lower trend line of the pennant structure, ideally accompanied by a surge in volume, signaling that sellers have regained control. Next, we have the ascending triangle pattern, a bullish continuation chart pattern that forms when the price repeatedly tests a horizontal resistance level while forming higher lows, supported by a rising trend line. This pattern suggests that buyers are gradually gaining strength, consistently pushing prices higher, although they face resistance at a specific level. The converging resistance and rising support form a triangle-like shape, with pressure building toward a potential breakout. The pattern is confirmed when the price breaks above the horizontal resistance line, signaling a high probability that the uptrend will continue. Conversely, the descending triangle is a bearish continuation pattern that forms when the price repeatedly tests a flat support level while creating lower highs, contained by a descending upper trend line. This pattern indicates that sellers are gradually gaining strength, consistently driving prices lower, although they encounter buying pressure at a key support level. The converging support and falling resistance create a triangle-like structure, with momentum building for a potential breakout. The pattern is confirmed when the price breaks below the horizontal support line, signaling a high probability that the downtrend will continue. Now that we've explored the most common trend continuation patterns in detail, let's focus on what really matters: how to trade them effectively. The first and most important step is identifying the dominant trend. Continuation patterns only work when they occur within a strong existing trend, not in sideways or choppy markets. Use higher time frames to establish the broader trend direction before looking for patterns on your trading time frame. Once a valid pattern forms, patience becomes key. Wait for confirmation, usually in the form of a breakout from the pattern structure. A breakout should be clean and ideally supported by a noticeable increase in volume. Your entry should be placed just after the breakout, never before. Entering too early, during the consolidation phase, exposes you to fakeouts and choppy price action. Stop-loss placement is equally critical. For bullish patterns, stops are generally placed just below the consolidation zone. For bearish patterns, just above it. This helps protect your trade without placing the stop too close to market noise. When it comes to target projection, a common approach is to measure the height of the prior impulse move, the flagpole, and project that from the breakout point. This gives you a realistic and logical profit target based on the strength of the previous move. Now let's look into some real chart examples. In this example, we can observe that the price is in an uptrend, and a bullish pennant pattern has formed, indicating a period of consolidation and indecision within the prevailing bullish trend. As the triangle narrows, we patiently wait for a breakout to confirm the next potential move. Eventually, the price breaks above the upper trend line of the triangle, signaling a likely continuation of the bullish trend. This breakdown presents a potential entry point for a buy position, as the momentum shifts back in favor of the buyers. In the next example, the price is in a strong uptrend, and an ascending triangle has formed, characterized by a horizontal resistance line at the top and a rising trend line of higher lows beneath it. This structure indicates that buyers are gaining strength, consistently pushing the price higher against a key resistance level. We wait for a confirmed breakout to validate the pattern. As shown in the chart, the price breaks and closes above the resistance line, which serves as a confirmation signal. This breakout presents a potential entry point for a buy position, as there is a high probability that the uptrend will continue. Place your stop loss just below the most recent swing low inside the triangle pattern, and use a measured move approach by projecting the height of the triangle upward from the breakout point. Now that you know how to trade trend continuation patterns properly, it's equally important to understand what not to do. Many traders make avoidable mistakes that turn high-probability setups into unnecessary losses. One of the most common errors is entering too early, before the breakout is confirmed. Anticipating a move without confirmation can lead to being trapped inside the consolidation zone, or worse, caught in a false breakout. Another frequent mistake is ignoring the larger trend context. Continuation patterns are only reliable when they appear within a strong and established trend. If the market is range-bound or lacking momentum, these patterns lose their edge. Traders also often misidentify patterns, confusing flags with channels or seeing pennants where there's simply noise. Misreading structure can result in poor entries and misplaced stop losses. Always wait for clear, textbook-like formations before acting. Placing stop losses too tight is another issue. A well-placed stop should account for natural market fluctuations within the pattern. Tight stops inside the consolidation range often get hit prematurely, even if the setup later works. Additionally, many traders chase breakouts after they've extended, entering late and getting poor risk to reward. Remember, if the price has already moved significantly beyond the breakout point, the opportunity is likely gone. By avoiding these mistakes and approaching continuation patterns with discipline and clarity, you significantly increase your chances of consistent success. If you found this video helpful, don't forget to like, subscribe, and hit that bell icon so you never miss our next video. If you have any question, drop it in the comment below. Thanks for watching, see you in the next video.